This is what everybody said is gold is a great hedge against inflation, high street inflation. No, it isn't. It's a hedge against monetary inflation. And that is the crucial difference. And what we're seeing worldwide is a breakout in monetary inflation because central banks have been called upon more and more and more to monetize huge levels of government debt. And this is the problem the world economy has got. There is too much debt. We can't get rid of that debt. Debt is piling up and it needs to be sold. And the only solution out there is for central banks to monetize it away. And that means the gold market's going up. We think gold is in a bull market. In fact, I'd even say controversially, gold's probably been in a bull market ultimately since the late 1990s. That's when the central banks really lost control of things. And that's when they had to start printing money. And you've seen this huge uplift in financial assets and gold really ever since. And it's going to continue.
According to Michael Howell, CEO of Cross Border Capital, the gold market is experiencing an upward trajectory driven by the escalating global debt crisis. The national debt has recently surpassed $33 trillion, a historic high resulting from extensive post-pandemic spending. Projections from the Congressional Budget Office suggest that this debt could surge to $50 trillion within the next decade. Howell asserts that the solution to this mounting debt is for central banks to resort to debt monetization. Debt monetization involves financing government deficits by increasing the monetary base, a process that shifts the aggregate demand curve and increases the price level. This mechanism, Howell argues, is a pivotal factor propelling the gold market to higher levels. As of the latest update, the gold price is holding above $2,060 during the early Asian session, with the last week of 2023 expected to be quiet due to light trading volume, experiencing a marginal 0.09% decrease on the day. Reflecting on the early 1990s, Howell notes a period when the Federal Reserve actively targeted the price of gold. The strategy, involving an assertive tightening of monetary policy, aimed to gain control but ultimately resulted in a significant financial crisis. This crisis, exemplified by the Mexican peso crisis in the mid-1990s, stemmed from a shortage of dollars, highlighting the challenges central banks face when attempting to manage market conditions. The historical context of central banks adopting inflation targets in 1990 is presented, emphasizing the goal of transparency in monetary policy. By the late 1990s, gold was valued at around $360. During the 1994 presidential election, an expansionary fiscal and monetary policy in response to the Mexican peso crisis attracted foreign investors. Howell draws a connection between this historical event and the current situation, suggesting that attempts to tighten monetary policy can lead to financial crises, thereby influencing the gold market's trajectory. Let's delve into key moments from Alasdair Macleod's interview with these video clips.
At the outset, let me say that we're very optimistic on gold, so that's a sort of a starting point, a taster. The puzzle in a way is to say, look, the background going into 2024 doesn't look great, does it? I mean, Federal Reserve wants to keep real interest rates high, arguably over 1.5%. Inflation backdrop looks like it's dropping away. I mean, those are the two ingredients which should mean the gold market goes down. But there's a lot more going on than that. And I think what you've got to try and understand is the backdrop and why gold goes up. And the fundamental point that we keep making is that gold is not a consumer price hedge, okay? This is what everybody said is gold is a great hedge against inflation, high street inflation. No, it isn't, okay? It's a hedge against monetary inflation. And that is the crucial difference. And what we're seeing worldwide is a breakout in monetary inflation because central banks have been called upon more and more and more to monetize huge levels of government debt. And this is the problem the world economy has got. There is too much debt. We can't get rid of that debt. Debt is piling up and it needs to be sold. And the only solution out there is for central banks to monetize it away. And that means the gold market's going up. We think gold is in a bull market. In fact, I'd even say controversially, gold's probably been in a bull market ultimately since the late 1990s. That's when the central banks really lost control of things. And that's when they had to start printing money. And you've seen this huge uplift in financial assets and gold really ever since. And it's going to continue. If you go back to a period in the early 1990s when the Federal Reserve in particular was targeting the price of gold very clearly, the only way it could get control was by actually tightening and maybe over-tightening and creating a crisis, creating a scarcity of liquidity. The problem was what we ran into then was significant financial crisis, with the evidence being the Asian crisis in the in the mid-1990s, when that was just a shortage of dollars caused the problems there. And from that point on, every time the central banks have tried to step away, in other words, squeeze the market, there's been a financial crisis. They can't do it. The end game is probably a lot more monetary inflation. What you're going to see is the empowering of monetary inflation hedges like gold and probably cryptocurrencies. That's where investors have got to start to move. And what we've been in this sort of luxurious situation for the last 10 years or so, or 15 years, of actually low inflation. And people really haven't, low high street inflation, people haven't had to sort of confront the problem. Now they're having to confront the problem. I mean, a great example is to look at Japan. In Japan is now veering onto a course of much, much higher inflation. The latest inflation data show in parts, parts of the Japanese price structure are inflating in double-digit rates now. This is unheard of in Japan. And you've got Japanese households sitting on half of their entire financial assets in cash, right? I mean, that is a mad investment strategy for an inflationary environment. It's brilliant if you've got deflation, which they had, but it's madness now. First thing to say is what do we really mean by liquidity? What we're not talking about here is sort of conventional money supply definitions. I mean, those sort of, they're an archaic definition. They don't mean very much now. Central banks and analysts like to talk about them. They're kind of meaningless unless you believe that the banks, in other words, the high street banks, still have a measure of control, and they don't. The world has moved on. And what we're looking at is the money flow through financial markets. I mean, that includes a lot of wholesale money, repo activity, these sorts of things. And it's that which is really the critical thing we monitor. Now, central banks influence that to a very large extent. One would have to accept that. And so what we're doing is we're monitoring what central banks are doing, what the wholesale financial markets are creating in terms of liquidity, and also looking on top at cross-border flows of money, because those can be particularly important at different times. That money flow moves markets. It moves financial assets, it moves the gold market, etc. And it moves in a cycle. That cycle is roughly something of the order of 5 to 6 years in duration. We're coming out of a trough. That trough bottomed, we think, in October of last year, October of 22. It's rising to a new peak probably around late 2025. It won't be a straight line up, but the fact is investors now have the wind behind them. And what you're looking at in a number of asset classes, and you've just got to look at US technology, look at US cryptocurrency, even look at the gold market. All these things are catching a bid now. They're starting to feel the wind behind them. And economists keep pounding the table and saying, well, look, watch out, there's a recession around the corner. But they've been saying this for, 18 months now? Nothing is happening. The old models don't work, and what you've got to start looking at more and more is what's driving the world, and it's these money flows.
BRICS nations are amassing substantial amounts of gold in a noteworthy trend, positioning themselves as major buyers of the precious metal in 2023. There is speculation within financial circles that these nations might consider backing a forthcoming currency with gold, presenting a potential challenge to the dominance of the US dollar. Russia is a key player in this gold accumulation, which has significantly increased its gold holdings from 1,112.5 metric tons in October 2014 to an impressive 2,329.6 metric tons as of January 2023. Michael Howell emphasizes that the central argument revolves around these nations actively diversifying their reserves by accumulating gold. This strategic move is seen as an alternative to holding large reserves in US dollars, driven by concerns about potential U.S. sanctions and the desire to mitigate economic and geopolitical pressures. Adding to the dynamic landscape, BRICS Pay emerges as a significant project. Like Europe's SWIFT and India's Unified Payments Interface, this distributed payment messaging mechanism is a collaborative effort among BRICS member states. It aims to facilitate payments in local currencies within the BRICS bloc, presenting an additional layer of financial independence beyond traditional global payment systems. While Michael Howell dismisses the notion of another currency surpassing the U.S. financial system, he acknowledges the increasing importance of alternative currencies and payment methods. Gold and cryptocurrencies are recognized as potential contenders in this evolving financial landscape. Let's get back to the interview.
If you start to look at maybe non-G7 central banks, so we're looking really here of the emerging economies, the BRICS, etc. They are building gold because they don't really have any alternative unless they want to hold all their reserves in US dollars, which I think in the experience of the last 2 years is not a particularly sensible thing to do if the US can actually enact sanctions. And this is something which would spook a lot of policymakers worldwide. So you've got to find an alternative. And realistically, what is the alternative to the US dollar? One can say, probably the Swiss franc or the Singapore dollar, but these currencies are way, way too small. Nobody can ever put sizable reserves into them. The euro, you're more or less talking about a quasi-dollar, and it will suffer the same slings and arrows as the dollar anyway. So why even bother? And so the only assets you're really left with are physical commodities, or more particularly gold, which is among those the most monetary of commodity assets. So I think that it's inevitable that they're going to start by building up gold holdings, and they are. And I think the interesting point to ponder, which is actually something I'm going to say today, is if you look at the stock of gold held by the BRICS and by the BRIC friends, in other words, those countries that were interested in joining the BRICS forum in the summer, that total now surpasses the total amount of gold, which is 8,000 tons in Fort Knox. So for the first time ever, the BRIC nations are challenging the US as the major gold holder worldwide. So in other words, you could say that the marginal safe asset in the world economy is no longer the paper dollar. Inevitably, we're looking at a trend here. I mean, is the dollar going to be displaced as the major currency worldwide? No, that's very, very unlikely. The power of the dollar really rests or comes from the power of the US financial system. So if you say to me that the US financial system is going to be eclipsed by another financial system, I'll come quietly and say the dollar is therefore going to be a second currency. It'll be overtaken by another one, the renminbi or whatever it may be. But that is such a fanciful suggestion that any financial system could dominate the US at the moment that it's not even worth discussing. That does not mean to say that other currencies or other types of means of payment will not become empowered. So it may well be that gold or cryptocurrencies become more important, but we're still fundamentally in a dollar system. We know that the US in extremis will impose sanctions. And I think if you extend that to other countries like the Eurozone, they will impose sanctions as well. I mean, they are technically. So the reality is that currencies are political. We know that. We know it more now. So you want an apolitical currency, which has got to be gold. And I think that's the reality of why central banks around, let's say outside of the G7, are buying gold more and more.
Will the significant gold accumulation by BRICS countries in 2023 mark a turning point in global currency dynamics, potentially challenging the supremacy of the US dollar? While the US dollar remains a dominant force in the global financial system, how significant is the potential rise of alternative currencies and payment mechanisms, such as gold-backed currencies and projects like BRICS Pay, in shaping the future landscape of international finance? Share your thoughts in the comments section. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.